9 mistakes that you're making when purchasing your next property. Today, we're going to share the do's and don'ts of mistakes that you probably may have made or could be making when it comes to purchasing your next investment property. And towards the end of the video, you're going to have a much better understanding of the do's and don'ts and how to automate the process to help in the expansion of your real estate portfolio. Mistake number 1, believe that savings is the only path to buy your next rental property. Yes, that is true that savings goes a long way, but for those who didn't know, every time you purchase an investment property, you will need a 25% down payment. And while savings is one way, saving 25% of a down payment for your next purchase can probably take you quite some time. The good news is there are other tools that you can leverage to expedite that waiting time and get enough for the down payment of your next property and your next one and so on until you reach that number that you want. And that leads me to the second mistake, and that is not understanding how equity works. For those who didn't know, let's say, for example, if you purchase a home and you pay 25% down, let's say this is an investment property, that 25% that you pay as a down payment, that belongs to you. That is your equity. But that is only 25%. You still have the remaining 75% to go, right? So another way to keep building up that equity is by paying your mortgage. So little by little throughout the years, as you continue to pay down your mortgage, part of that money is going to go towards interest payment and part of that money is going to go towards your equity building. So that's one way in how you can continue to build up that equity. Another way is just to pay your mortgage and do nothing, right? Because you will let market appreciation take care of everything. And if you're located in a good area where the market appreciates, your house will go up in value over the years. Sometimes it might not go up, but it will all depend on the local economy. And if the property goes up, then that means that you will continue to get additional equity added to your net worth. There's another way in how you can add to that equity building, and that's by forcing the appreciation through renovations. You can buy a property and do cosmetic renovations, or you can do a house flip and just add value to the house, and then you build up enough equity to the point that you can actually take it out through different financial programs like a HELOC, which can be done only in primary residence, or a cash out refi. In fact, I did recently hear that there is a program that is called HELOC for DSCR, and that's in essence a HELOC for investment properties. So the main difference between a HELOC and a cash out refi is that a HELOC, it's a line of credit. So you will only pay interest based on what you use. While with the cash out refi, you're just getting a lump sum and you're pulling your equity all in one shot and you have all that big lump sum to use. Either way, when you pull that equity out, that is your new down payment. And when complemented with your savings, if you have any, then you create more and more opportunities for you to keep expanding your real estate portfolio. Welcome to Novaris, your channel for financial education. In here, we talk about investments in real estate, investments in the stock market, in precious metals, and small businesses. Next mistake, not having enough income to justify getting more mortgages or to get a new higher mortgage. For those who didn't know, if you were to do a cash out refi, that is in essence a new mortgage. You will go through the entire financing process and whatever equity you pull out, it will be yours and the bank will pay off the old mortgage so that way they can maintain that first position in the lien. Something similar will happen with the HELOC, with the difference is that the HELOC will be an additional debt to your existing mortgage. And both scenarios, the lender will need to make sure that whatever money that you're declaring in your income taxes is enough to cover the debt. Call it a HELOC and your old mortgage or the new mortgage, because now we're talking about you pulling new equity out and that translates to higher mortgage payments. So before you do that, don't just simply rely on your income, but if you happen to have a rental portfolio, make sure that that rental income, it's being reported in your taxes, because that's what's going to help you to balance out that DTI, that debt to income ratio, and allow you to qualify for additional funding in the expansion of your real estate portfolio. Next mistake, believing that your reserve funds have to be in your savings account. For those who didn't know or who are brand new to real estate investing, when you finance the purchase of a property through a mortgage, the lender is going to ask you for reserve funds, typically 3 to 6 months, depending on the type of mortgage that you're applying for. And those are meant to cover your mortgage payments in the event that an emergency happens, or if you happen to have an investment portfolio, it is used to cover the mortgage payment in the event that your property is not rented out yet. So I've heard of some cases in the past where people are holding off to buy their property because they know they don't have the reserve funds and they don't want to get denied by the bank. But the truth is that your reserve funds don't have to be in your bank account. You can use other assets that are highly liquid to prove that you have enough reserve funds. For example, if you invest in the stock market and you have a sizable amount of money invested in your brokerage account, that brokerage account can serve as a reserve funds account that can prove that you can cover that mortgage liability. The same applies if you have a retirement account. Some of you have 9-to-5 jobs. So if you have a 401k or if you have an IRA, the funds that you have invested in those accounts, they can also serve as a reserve funds account. Does it mean the bank is going to ask you to liquidate them? No, they just want to see that you have the funds there and you should be able to move forward to the closing. Now, if you choose to liquidate them down the road to make sure that your mortgage payment is paid, that will be entirely up to you. But your reserve funds don't have to be in a savings account. It can come in many different forms, including your brokerage account if you invest in the stock market or your retirement account. Next mistake, not having a FICO score of 720 or above. Yes, you can still qualify for mortgages if you have less than a 720, but when you have 720 and above, you qualify for better rates. And when you have better rates, that means lower mortgage payments, which can translate to higher cash flow because now you're putting less towards interest and you're keeping more money in your pocket. In fact, I have a tip for you. Did you know that you can increase your FICO score without necessarily paying down the debt that you have? All you have to do is to review all of your credit cards and call the 1-800 number in the back of your card and request a credit line increase. Do it only if the credit line increase is granted through a soft pull. If you have to have a hard inquiry, then thank the bank and say no thanks and move on to the next credit card. Only to request a credit line increase if it comes with a soft pull. And what that will do is that it will increase your credit line. And when you compare that credit line to the existing debt that you owe, that means that now you're going to owe less money, which in essence will translate to you having less debt in your FICO score, and you will automatically give your credit score a bump. Next mistake, not buying points. For those who are brand new to real estate, when you apply for a mortgage product, you typically have the option to request, hey, can I buy points? And through those points, you can actually lower your interest rate in your mortgage. Now, it doesn't always make sense to buy points because sometimes it's better to keep that money in your pocket and then just pay extra towards the mortgage. But sometimes it does make sense to bring down that interest rate because it's going to help you maximize that cash flow in your rentals. Next mistake, not bundle your insurance. So let's say, for example, you have your first property and you're going to go buy your second one or even your third one. You can actually save money by contacting your home insurance broker and say that you want to get additional policies under the same company and see if they have a bundle discount. If not, consider going to a different insurance company. Some companies will give you an incentive to bring you in as a new customer. And when you bundle that up with additional insurance policy, then you get a bigger discount. And that will translate to a lower expense and higher cash flow in your rentals. Next mistake, not doing the proper market research and end up buying a property in a flood zone. Did you know that mortgage will make you buy a flood insurance in addition to your home insurance if your property happened to be located in a flood zone? Personally, I find that to be an unnecessary expense. So if you're in the market searching for your next property to buy, you should take the address of that property and check it on the FEMA website and see what their elevation is. If their elevation is at a point where it will require a flood insurance, your lender will ask you to get a flood insurance. So I will personally walk away from a property like that because I don't think it's worth spending that extra money. Even if it's for your primary residence, it's an unnecessary expense. And let's face it, if your property gets flooded, what an inconvenience. You will lose cash flow. You're going to have to invest money in repairs. And if it happens to be your primary residence, where are you going to move out to in the meantime, right? So let's do the research up front and look for a property within the vicinity that could give you what you're looking for in terms of cash flow without the added expense. And keep in mind that even if you happen to be in a state that is prone to flood, not all areas are prone to flood because of the different land elevations or because of the way the property has been built up. So some houses are built up with an elevation in addition to the actual elevation of the land. And that could help you save on flood insurance, even though you're located in a flood zone. Next mistake, not creating a folder to house all of the documents that are considered repetitive documents in every mortgage. For those who are brand new in real estate investing, you will realize over time that every time you apply for a mortgage companies will in essence require the same type of documentation. That is copies of your tax return, of your bank statement, and your pay stubs. So why wait until the very last minute to gather all that documentation when you can create a folder year by year and then start adding those documents as the months go by, so that when that deal comes in, all you got to do is to drag and drop or just simply upload whatever you have into the portal when you're applying for a mortgage, and that will expedite the process even more, helping you save time and get to that closing a lot faster. For those looking to expand your real estate portfolio, check out this video that's going to tell you the worst properties to buy this year, so that way you can prevent making that mistake as well. See you in the next video. Take care. Bye-bye.